Is that danger? Is that chance? It is the chance that a business or an organization may not meet its long-term goals. It may not meet its long-term goals. It may not meet its long-term goals, right? Her profitability may be in doubt, etc. Ladies and gentlemen, business risk also refers to fluctuations in business's earnings. Business risk, long-term, business risk refers to its long-term fluctuations. It may not meet its long-term goals. Fluctuations. It may not meet its long-term goals. Businesses in the profitability may be in doubt, etc. Business risk also refers to fluctuations when you move from a profit zone, business risk to a loss. Business risk is a chance of you failing over having what you call fluctuations. It may not meet its long-term goals. Business different from audit risk. Profitability may be in doubt. Ladies and gentlemen, business this is that chance of moving a profit zone. Business risk to a loss. Business risk is a chance of you failing over having what you call fluctuations. It may not meet its long-term goals. Business different from audit risk. Profitability may be in doubt. In this case, you are able to determine your profitability. This is that chance of moving a profit zone. Business risk to a loss. Business risk is so that at the end of the day, of you failing over having what you call fluctuations, or may not meet its long-term goals. Business you are supposed to give from audit risk. Profitability may be in doubt. In this case, the financial statement business this is that chance, and you are not able to profit zone. That is what a loss. Business is as a quick recovery over having what you call fluctuations. May not meet its long-term goals. Business from audit risk. Profitability may be in doubt. The financial statement this is that chance, and you are not able to have a business as a quick recovery over having what you call fluctuations. Long-term same as audit risk. Financial statement this is that chance, and you are not able to have a the company can put in a lot of controls. It can put in controls thinking that they have been able to capture all within their organizations because of the nature of the business. Some businesses are very complicated. You'll get, ladies and gentlemen, some businesses are having subsidiaries in Mauritius. In Kenya here, they have branches all over. When you have a very sophisticated business model, automatically you increase what your risk levels, because some of the activities you are doing, ladies and gentlemen, their organizations that you are doing, their organizations, because of the nature of the business. Some of the activities of the business cannot be at the control of. You'll get, ladies and gentlemen, and then now control risks. You guys told me something about this. In Kenya, here they have a branch all over.
To remember what you told
when
me
you
about
have a very
risk?
sophisticated business model, automatically you increase what your risk levels, because some of the activities you are doing, ladies and gentlemen, they are organizations that you are doing,
they are organizations because of the nature of the business.
Some of the
nature of the
business cannot be at the control of. As you guys get, ladies and gentlemen,
remember we said, and then now control risk. You guys told me something about this,
ladies and gentlemen, or that in Kenya, here they have a that likelihood. Remember what you told me
that
whatever procedures the auditor will put in automatically will not be able to catch, because will not be able to intervene, ladies and gentlemen, errors and they are organizations within their organizations because of the nature of the business. Some of the nature of the business cannot be at the control of. As you guys said, ladies and gentlemen, remember we said, and then now control risk. You guys told me something about the financial statement. In Kenya, here they have a that likelihood that whatever procedures the auditor is the risk that arises will not be able to catch, because will not be able to weaknesses of the within their organizations because of the nature of internal control. Remember, this is what we call the risk of material. As you guys said, remember we said, and then now control risk. You guys told me something about the financial statement. In Kenya, they have a that likelihood that whatever procedures the auditor is the risk that arises will not be able to catch. If you look, cannot be able to if you want areas of the within their organizations because of the nature of internal control. Remember, this is what we call the risk many times. As you guys said, remember we said, and then now control risk. You guys told me something about the financial statement. We have whatever procedure is the risk that arises will not be able to. May 2018, question number 2A. Are we there? May 2018, question number 2A. Mary is saying September 2021, they also gave us something, question number 1, about business risk. May 2018, question number 2A. May 2018, question number 2A. Are we there? Yes, I have to give them to you today, immediately after this. So please, first of all, tell me, have you been able to get that question of May 2018, question number 2A? May 2018, question number 2A. Mary says, yes. Wakatuambia pale, discuss, you start by reading the requirement. Discuss the relationship between the concepts of business risk and financial statements, what are risk in a company, drawing references from the above scenario. So again, a quick reminder, we've just said that business risk is a chance that a business may not be able to meet its long-term goals. Remember, the long-term objective of any of these entities here is to maximize what your profits. So if you're not able to meet, ladies and gentlemen, this kind of a goal, then that is a business risk. Remember, business, as the name suggests here, business is supposed to be busy, right? But it reaches that time, ladies and gentlemen, when we shall have like what we call management wrangles. We shall have conflicts of interests, right? So many of these risks that are really trying to place their grasp on the business not to continue as a going concern. All those things, they will fall under what we call business risk. As a going concern, there is a very high chance that you may be able to get into losses simply because you've got quite a high loans. Gearing levels, that's a business risk. So if you read here, Madawa Limited has been manufacturing herbicides for the past 10 years. Your firm, Maui Now and Associates, have been the auditors of Madawa Limited for the last 3 years. Recently, the following extract on Madawa Limited appeared in a national newspaper. It appears that Madawa Limited has breached the local planning regulations by building an extension to its research and development unit for which no approval was sought from the county government. Ladies and gentlemen, I can see an organization here that is breaking the laws of a country, right? We do not know. At the end of the day, this county government will come and say, demolish the entire whatever. There will be fines here. So this is quite a big business risk. The land on which the premises are situated is protected as a riparian land
which means that approval by the county government is necessary for any modifications to commercial buildings. I can see a big risk there. In addition, a representative of the county government's planning office was recently quoted as saying, "We feel that there is a serious breach of regulations. This is not the first time that Madawa Limited has deliberately ignored and established planning rules in the county." Ignored established planning rules in the county. The same company was successfully sued in 2013 for constructing an access road to their factory without receiving prior approval from the county. We are considering taking further legal actions for this breach. So discuss the relationship between the concepts of business risk and the financial statements risk. So, ladies and gentlemen, you have been able to define for Mwalimu what business risk is. How about you guys taking a step further and defining for me what financial statements risk is? Financial statements risk, from the word risk, risk means chance, likelihood. So it is that likelihood that the financial statements of an entity may not present the true picture of an organization. That chance, that likelihood that the financial statements of an organization may not portray what we call a true and a fair view. All right. So, ladies and gentlemen, remember here there are so many contingencies. This company is being taken to court. And for that matter, for the second time, and the first case they lost, right? So there are a lot of contingencies here. These contingencies that we are not so sure of their outcome will, of course, affect our business. So then what I'll need to do is to make arrangements in a way that, first of all, I'll be able to define what business risk is and give an example of this dangerous thing that may kill the organization. We don't know how much our lawyers will be eating from us, right? We are going to eat onto the earnings of the business. That's a business risk, right? It's a business risk. We don't know in this case here how much in terms of fines these judges will tell us to pay this time around. Business risk. When it comes to financial statements risk, ladies and gentlemen, I can straight away see that there is quite some misrepresentation here. The financial statements that these guys must have produced have not captured any provisions. They have not captured any provisions regarding what is this court case. So there is a very high chance that the financial statements are also misstated. That is the risk you're talking about. But now this is why students fail in this paper, and they fail miserably thinking that they know too much. No. Why students in this case, ladies and gentlemen, will fail this paper, look at that question very well. They wanted us to give them the relationship between business risk and what here? Financial statement risk. Are they related, somebody? Somebody please take a minute and engage me here. Are the two related? Are the two related? Business risk and financial statements risk. Are they related? Yes. How? 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 Please advise me. How? Please advise me. May 2018, it's May 2018, question number 2A. May 2018, question number 2A. Please, you're not answering my question. May 2018, question number 2A, yes. I can see somebody who has given me something very nice there. I can see somebody who has given me something very nice there. Maureen, I like your answer, but you see that answer cannot give you 2, 3 marks. It'll only give you 1 mark. It'll only give you 1 mark. Ladies and gentlemen, remember when we talk of business risk, we are looking at the dangers. We are looking at the dangers of this organization in the long term being challenged in terms of what here going concern. The going concern status of this company will easily be what here will easily be challenged. Now listen and listen to me very well. Going concern under threat, under threat. Now, when the going concern is under threat here as a company, what we'll do is that management will try to conceal. We'll try in this case here to conceal the going concern issues. Going concern issues by manipulating financial statements, by manipulating financial statements, by manipulating financial what here statements. Very important. So meaning, ladies and gentlemen, that this business risk at the end of the day will have an impact on the financial statements, right? Because at the end of the day, these managers here will try, they don't accept that easily their firm is under going concern threat, because if they accept that, then automatically during AGM, those directors will be sacked, all of them. They cannot accept that easily. All right. Now we are saying something very important here, that business risk will lead to what here? Business risk will lead to going concern of a company being under what here? Being under threat. And when the going concern of a company is under threat, the management here will try to conceal that going concern issue by manipulating what here? Financial statements. Manipulation of financial statements is what we call what here? The financial statements, what here? Risk. The risk of misstatements. The risk of misstatements. Ladies and gentlemen, listen and listen to me very well here. Business risk also means what? Business risk arises out of what here? Out of weak internal control systems. Out of weak internal control what here? Systems. Out of weak internal control systems. We know, ladies and gentlemen, at the end of the day that weak ICS will lead to misstatements, in or rather of financial statements. Will lead to misstatements of what here? Financial statements. Very important. So then at the end of the day, what are we saying? We are saying, ladies and gentlemen, at the end of the day, like in this question above, there is a big business risk. In the question of Madawa, I'm trying to now contextualize. In the question of Madawa Limited, there is an eminent. There is an eminent court case, whose outcome, there is an eminent court case, whose outcome is uncertain, risky. Uncertainty is about what here? Is about risk. Whose outcome is uncertain. Whose outcome is what here? Is uncertain. At the end of the day, ladies and gentlemen, we are saying that there are huge expenses. Huge expenses are expected here. Huge expenses are expected. This could put the firm's going concern under what here? Under threat. And then at the end of the day, I'll say that these expenses have not been provided for. These expenses
have not been provided for. These expenses have not been provided for, implying that the financial statements are misstated. Implying that the financial statements are misstated. Implying that the financial statements are what here? Misstated. They are misstated. So in conclusion, I want you to mention there that in conclusion, there is a direct relationship. There is a direct relationship between business risk. There is a direct relationship between business risk and the financial statements risk. There is a direct relationship between business risk and the financial statements what here? Risk. And the financial statements risk. And the financial statements risk. So even if you haven't taken very good notes, this video is yours. This video is yours. I expect you guys to have a look at it again for you to be able to make better notes. But at a high level, have you been able to appreciate the discussion? Have you been able to appreciate the discussion, which was quite a good warm-up, for whatever we did in our last class? Have you been able to, great. Na inarudiwa zaidi hiyo swali ya business risk ukiona kama kuna wakati liletwa hapa, hii swali ya makao. Hii ya November 2016, just a high level again. November 2016, question number 2. 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 Ukiangalia part A, tuliza what are the audit risks in place. Part B, wakatuliza to summarize the advantages of a business risk approach. Part C, undertake a business risk assessment of KMG Limited. I'm actually interested in part C, Roman 1. Undertake a business risk assessment of KMG Limited. If we could read this together, we are told your audit firm, Macau Kilunda and Associates, are the auditors of Kikomi Manufacturing Group. The group comprises various subsidiaries which were acquired over the last 2 years. The subsidiary companies operate diverse businesses, including but not limited to mining, agriculture, beauty products, and steel manufacturing works. Those are too many things. That automatically is an inherent risk. It's too big to be managed. The CEO of KMG Limited, Mr. Tim Kilonzo, is very entrepreneurial and autocratic. Autocratic leaders are dictators. Dictators are very poor in terms of putting in place proper internal control systems. This is a big business risk. This is a person who does not even incorporate other people's ideas in how the business is being run. All right. So there I can see challenges. Like the first business risk I'm seeing there, which is also an inherent risk, the size of that company. These many subsidiaries, it will be very hard for us to manage them. Number 2, I'm seeing a fool of a man here who wants, in this case here, to take all decisions by himself, even at family level. Ukianza kupata mama anataka kumake decisions zote kwa nyumba, unajua hiyo ni shida, hiyo ni autocracy. Your family haita hold. All right? So tunaambiwa hapa ukisoma hapo chini kwamba KMG Limited is a highly geared. Highly geared is what form of a risk? It's a business risk. I'm just taking them high level. It's a business risk like that. Ukiendelea mbele, wanasema, and recently acquired a listed company dealing in information communication technology solution. So they have acquired a new company which is totally in a different industry. Business risk. So wanasema financial analyst had indicated in one of the respected financial magazines that the listed company was acquired
at a very high price compared to the value of its assets. This new farm has been acquired at a very high price. And this thing I told you this thing, ladies and gentlemen, when I was teaching some of you advanced financial management in terms of mergers and acquisitions. If you remember, if as a young man today, you end up in this case, ladies and gentlemen, as a young man today, you end up paying, for example, dowry of 3 million. You do a wedding of 2 million. That's 5 million. Tell me, after you finish this kind of an activity, do you have a life thereafter? Mzee kama mimi 5 million naweza si ati niko nayo, lakini atafuta madeni nitaweza. But a boy who is 27 years old, do you think after he has incurred this kind of money, at the end of the day, people will be at peace? Hii pesa mingi ni loan. When you pay too high, itakuwa shida kwa hiyo familia. Huyu jamaa atakuja angalie, is this all that I really? Inakuwa international disaster because umeanza family at a bootstrapped level. Ungekuwa kijana mwerevu na bibi mwerevu, hii pesa mngeenda kama pale wapi, Kangundo Road, mpate kashamba kidogo na kanyumba hata kama kataisha, mwanze kuishi. Mnaanza na life na soft life. Hii harusi ni ya kushow off, but we shall overcome. You've just blown your money like that. The same case here. When you bleed, you pay like that. At the end of the day, ladies and gentlemen, you will get yourself into what here? Into issues. You will get yourself into issues. So that's a business risk. The moment you have overpaid like that, it means, ladies and gentlemen, that we shall get into cash flow challenges. At the end of the day, then we shall not be able to move on as a going concern. Another large subsidiary which manufactures skin products has been sued by customers of some products which have allegedly adversely affected their skins. Dangerous. Many cases there. Some farmers also allege that the maize seeds supplied by one of the subsidiary companies were faulty, and thus the seedlings withered 1 month after germination. Great. So at least now najua mnaweza mkajua kitu ya kuandika hapo ilikuwa namna hiyo. Haya. So just a minute. Right? Don't bother a lot about writing the notes because already the ACCA notes that I gave you have these concepts. I'll be able to pinpoint to you the page number. The most important thing for you today is to ensure you get this concept here. Somebody, even if it's through Googling, could you kindly do whatever you're doing there and give us the proper definition of materiality? What is materiality? Because if you remember, the major objective of auditing is to ensure that the financial statements are free from material misstatements. Of course, ours is to give an opinion. But at the end of the day, we know, ladies and gentlemen, at the end of the day, ladies and gentlemen, we are there as great inspectors to ensure that there are no material misstatements. So the word material is there. So this materiality, somebody has already given me some good definitions here. Thank you very much. I can see good definitions here from Clement. A matter or information is said to be material if its omission or misstatement. If its omission or misstatement affects the decisions of a user. Mr. Stephen Guga tells us that materiality occurs when its omission or misstatement could make the auditor change his decision. Shouldn't be the auditor really, Guga, should be the users. Listen to me very well. If, for example, we have our profitability looking like this, we have revenue, for example, of 10 million. We have labor, for example, of 12 million in a year. We have overheads of, for example, something like 2 million. If I deduct this, and this like that, I will be able to get profit of -4. It's a loss of 4 million. Now, assuming that this is the actual status, you will get in this case here out of creative accounting,
out of creative accounting, these guys may want to show this as a profitable situation. So they'll come and, for example, maintain the 10 million revenue. But for labor, they'll come in this case here and change, give us a figure, cheat us, tell us that their labor was just 8 million, not even 8, talk of 6 million like that, right? The overheads can remain. So if I do it that way, then, ladies and gentlemen, 10 minus 8 here will now give me a whole profit of what here? 10 minus 8. 10 minus 8 gives me a whole profit of 2 million like that. Now, you see, when I present this financial statement here to the users, to the stakeholders of the entity, what will happen? Some of these stakeholders here may decide to increase their investment. They may decide to increase, they buy more shares in the company. Had you given them this, they would not have bought. So it means straight away that this labor is what here is a material item. Why? Because misstating it has made some users of this financial statement here to change their decisions. They have picked a different alternative. So thank you very much. You guys are still giving me more. They're telling me, Anne is saying that, Mwalimu, you are not audibly enough. Check your net. Yes, I'm okay. I'm able to see my signal here. Anne, sorry. Sorry, Anne, sorry. Great. Ladies and gentlemen, listen and listen to me very well. My concern today is to help you guys know how to set materiality levels. How do we set, first of all, the overall materiality level before we go to the performance materiality level? Ladies and gentlemen, assuming here we have a low-risk company. Low-risk company, and then we have a high-risk company. I'm putting, in this case here, the errors. I'm putting the errors from these companies in baskets. And which risk am I talking about? I'm talking about ROM, the risk of material misstatement. The risk of material misstatement. When I talk of risk of material misstatement, I'm looking at two components. I'm looking at two components of the audit risk. I'm looking at the inherent risk, and I'm looking at what we call the audit, what here? Not audit risk, but control risk. Control risk, these two. Inherent risk and the control risk, like those two, like that. Now, a company that is having a low risk will have very few errors. Low risk company. When the risk of material misstatement is low, it means you'll have very few. When your internal control systems are working, you will have, in this case, ladies and gentlemen, very few errors like that. Very few errors like that. All right? Very few errors like that. Okay, let me just put this up a little bit like that. What about a high risk company? High risk company will have errors all over. We'll have errors all over. We'll have errors all over, 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 all over. We'll have errors all over like that. High risk. Dangers are too many like that. Now, you know, for a low risk organization, if I come and set my materiality level up there, right? If I come and set my materiality level up there, I'll not have a problem. Why? Because at least here, I'll be able to check on two items whose values are more than the materiality level. I'll be able, ladies and gentlemen, here to check a few. There'll be very few really, which are on top. And then, of course, any value whose, or rather any item whose value is less than the materiality level will be referred to be immaterial. And if it's immaterial, then I will not audit it. I'll not put big procedures to it. Now, assuming for the other company, ladies and gentlemen, if I come and put at the same level, my materiality level there, right? What will happen? Of course, I'll be having quite many things to check up there. But you see now here, there is a problem. There will be so many things which will go under the carpet. We can see the errors that will go unscrutinized will be too many. And our aim as an auditor is to ensure that we set a materiality level where we shall be able to examine many things, right? We don't want, in this case, ladies and gentlemen, the risk of misstatement here not to be detected by ourselves. So if there are errors, then many of them should be done what should be investigated. And that is why if it is a high risk farm, then the materiality level can never be set high up there. If it is a high risk farm, ladies and gentlemen, you must lower your guard. You must lower your guard and have the materiality level being down. Listen and listen and listen to me very well. Materiality, and the risk of material misstatement are inversely related. They are inversely related. They are inversely what here? They are inversely related. Meaning what? When the risk is low, when this ROM is low, you put a high materiality level. You put a high materiality level. When your materiality level is high, when materiality level is high, ladies and gentlemen, remember when the materiality level is high, it means straight away that the controls that you have are working. The controls you have in a company are working. So in this case here, I will be doing very few substantive tests, right? So when the materiality level here is high there, I'll be having very few items here to check. So in this case here, when materiality level is high, there are very few items to be checked. Few items will be checked here. Few items will be checked. Few items will be checked. Why will we have few items here being checked? Reason is the ROM is low. The ROM is low. We've just said here that materiality and ROM are inversely related. When one is high up there, the other one is what here? Is low. This is something that is all over there in your past papers. Very, very important. And I am so sure many people in this case here really confuse this thing. Many people confuse this thing. ROM, remember ROM is the risk of material misstatement, the risk of you making errors as a firm. The risk of material misstatement. The risk of material misstatement. When it is very high, it means more errors, higher level of errors. Now come here. Here, what is happening? We have got high risk. So if the risk is high, what do we do as auditors? We want to check more things, then we lower our materiality level. We lower our materiality level. We lower our materiality level. Now, this may look useless, but it's very important for you to do what here? To have these two buckets down in your notes. Very important for you to have those two buckets down in your notes. And once you finish, please let me know that you have finished. This basically covers my entire concept of materiality. Concept of materiality. This covers the entire concept of materiality. Once you finish, mention there why for yes, so that I can continue. Once you finish, say why for yes, so that I can get to continue. Great, thank you very much. Now, ladies and gentlemen, listen and listen to me very well here. There is something I still want you to understand. There is something that I would want you to understand. Assuming today you're moving from Nairobi to Kisumu, there are many options, but I would want us to consider two options. One option is a train. The other option is an aeroplane. Now, ladies and gentlemen, between these modes of transport, which one is having within itself a higher risk? Ni gani ile ukiingia unasema ndio, ni gani iko na risk kubwa kushinda nyingine? B, aeroplane, yes. So wewe ukiwa inspector, ukiwa inspector unataka kuangalia kwamba kutakuwa na accident, ukuwe inspector wa train na mwingine akuwe inspector wa aeroplane. Unafikiria nani atafanya kazi mingi sana? Kwa inspector wawili. Hata wa train wanaangalianga kitu kweli. Kuangalia degrees. Because unajua train ukienda na mkapata accident, at least hapa unaweza ukabaki hata 50%. Right? Unaweza maybe katika mguu, right? Unaweza katika mguu unfortunately, lakini chances za uta survive. But you see aeroplane accident yake ni 100%. Hapa the risk is very high. So kumaanisha kama inspector hapa lazima angalie kila kitu, anaangalia vitu vidogo. Anaangalia vitu atakani kataa, anakuja anaangalia nini hapa kama iko sawa. Unapata the inspectors hapa wanakuwa wengi sana, tena specialized. Unaangalia for example hii kitu ikienda ile mguu itawaachilia, ikienda ku land. Unaangalia everything, safety belts, everything. Hapa there is nobody who checks whether safety belts are working. No. So inamaanisha, ladies and gentlemen, if it's an auditor, we're looking at this as two companies. This one here is a high risk. If this was a company, it will be called a high risk company. And for high risk company, what have we said about materiality level? Will you put a high materiality level or a low materiality level? A low materiality level so that you can get to inspect all the many things upwards. You start from low there, everything from the cockpit up there. Lakini ikija ni train, unajua train hii ina mambo mengi. Sana train kama hapa Kenya. Train hapa Kenya kusema ukweli, I mean, the worst it can do ni kuderail kidogo namna hii, right? So unapata as an inspector, it is up there. You check only a few things. Grease, right? You check very few things like that. Very few things. Ladies and gentlemen, listen here. So now we come to a very important thing called what here, somebody? A very important thing called what here? The materiality threshold. Materiality threshold in the auditing language now here. So materiality thresholds. Threshold values. We normally talk of the auditor's materiality RAP. So RAP is what here, somebody? RAP is revenue. It is assets. It is profit after tax. So revenue, we normally talk of 0.5%. Assets, 1%. Profit after tax, 5%. All the way to the upper limits. The upper limits, you multiply these figures by 2. The upper limits. So this becomes 1%. This becomes 2%. This becomes 10%. Like that. Materiality threshold, very important. RAP. May not make out of sense for you for now, but first of all, copy like that. Once you finish, show me a thumbs up. Once you finish, show me a thumbs up. Great. Thank you very much. RAP. Haya. Sasa nataka unisikize vizuri sana hapa. Utakuja hapa upatiwe financial statements. For example, upatiwe income statement of RCM Zoom College. RCM Zoom College. Like that. Upatie financial statements. Great. Wakwambie revenue. Wakwambie revenue is 20 million per year. All right. Wakupatie costs. So cost tuko na distribution cost maybe 5 million. assuming you're distributing our books to our students all over Africa. Then we have administration costs. Administration costs, maybe 3 million, 3 million, 3 million, 3 million, 3 million. Then we have, for example, finance cost, maybe 200,000, 200,000, 200,000, 200,000. And maybe we have tax. Let me put just a crazily low figure of 50,000. Okay, so could you kindly give me the profit after tax? Could you kindly give me the profit after taxation? Give me the profit after taxation. Please give me the profit after taxation. Just subtract for me. Give me the profit after who? The profit after taxation. So profit after taxation, somebody subtract for me. What are we getting here? Somebody, 20 million minus this minus 11, 750,000. So we have here 11, 750,000, like that, double on the line. Now, so what I'll do as an auditor, I'll come first of all and evaluate the internal control systems of RCM Online College. The college has been there for many years, right? Right. I look at the previous auditors. What have they been doing? What have they been saying about the college? Giving them a clean bill of health and qualified opinion. So straight away, I will know that this is a low risk company. Ukiambiwa kwamba kampuni ni mpya, ladies and gentlemen, kwamba imeanza like last year, like that, or just straight away kwamba this is a high what year? A high risk company, a high risk company. So if I've been able to establish and know straight away that this is a low risk company, for example, a low risk of material misstatement company, right? Right? Then what materiality level am I going to set? High or low? If it's a low risk of material misstatement, high. All of them are telling me high, high, high. So then if it is a high ML, and then I decide, you know, it's purely judgmental. It's purely judgmental, purely judgmental, purely judgmental. The ISA 300 series planning talks about materiality and tells us it's purely a judgmental thing. It's purely a judgmental thing. It's purely a judgmental thing. Now, ladies and gentlemen, if, for example, I decide and they say, I'm going to use profit after tax as my benchmark. They call this benchmark. Could you kindly give me the materiality level that I'm going to use for RCM Online College? For RCM Online College, I've decided it's low room, and I've decided that I'm going to use profit after tax as my benchmark metric, which runs from 5% to 10%. Wanafunzi washasema high, na between the two kuna low, kuna high. So umesema ni high. So then it should be 10% of the profit after tax. So then could you kindly give me this 10%? So then what is this ML for RCM? For RCM Online College, it is high. So then the materiality level will be, you can't use two benchmarks. You only use one benchmark. You only make use of what here? One benchmark, and we've said we shall use profit after tax this. So it should be 10% of this. So what is 10% of this, somebody? 10% gives me what amount? 1750,000. 1750,000. 1750,000. Like that. 1750,000. So then what does this mean to us? What does it mean to us? Can somebody talk to me? What does it mean to us? Is it an irrelevant thing as an auditor when you have this? Remember I told you, I showed you a bucket. I showed you a bucket and told you that when you have set your materiality level here, when you've set your materiality level there, anything that is on top, anything that is more than the materiality level must be audited, thoroughly investigated. So then I'll go to these items one at a time. So 20 million becomes material because it's more than 1750. 5 million is material. So I must really audit what your distribution cost. Here, because it's an example that I got from my head, there are only two things you'll not really audit. There are only two things that will not really audit so much, which are what and what here, somebody? Fixed cost and taxation will be taken to be what here? Finance cost. Finance cost and taxation will be taken to be what here? Immaterial. Will be taken to be immaterial. Will be taken to be immaterial. Kumbuka, ladies and gentlemen, auditing is a subject of substance. Auditing si subject ukienda ukisikia ati mtu amechukua toilet paper, unaweza kufuata watu wameiba toilet paper. Utakuwa sawa auditor ina gani? Immaterial things should be left out there. We are going into this thing to only look at what is material. What can make figures change decisions, make people change decisions because simply like a profit will be turned upside down by some of these figures here. So we are working with what we call materiality. So for your exam, nobody will ask you about this. For your exam, I expect you to master this thing of RAP. I expect you to master this thing of RAP, and the RAP that we're talking about, ladies and gentlemen, is RAP between what and what. Is there anybody who is able to remember these things of RAP? When we are setting materiality, we must recall RAP. When we are setting materiality, we have revenue, we have assets here, and then we have what we call profit after who? After tax. And then you should be able to just master the lower limits. This is 0.5%, this is 1%, and this is 5%. When I want to get the upper limits, what do? I will multiply by 2. So this will give me 1, this will give me 2%, this will give me what percentage there? This will give me 10% like that. So are we together up to there? And then please get to know the relationship between materiality and the risk of material misstatement. The inverse relationship. Once you know that, you're good to go to answer your exam questions. So are we together first of all up to there? Are we together up to there? Great. Now, ladies and gentlemen, the last thing that I would want us to define here is what we call the performance materiality. Actually, I would want you to differentiate for me the overall. I would want you to differentiate. So please differentiate here. You know, whatever you have set there is an overall materiality. One level of materiality which cuts across all the financial statements. But we know, ladies and gentlemen, that with the time, we can't really stick with just one level of materiality, because when we go to really investigating the components of the financial statements, we expect some components like revenue to be highly susceptible. So we want to have revenue figures, which are, or rather materiality for revenue to be different. But before I open up the can of worms, I would want somebody in this case here to distinguish for me through Googling or whichever way, distinguish for me the overall materiality vis-a-vis what here? Performance materiality. Are they the same? Are they the same? Overall materiality and performance materiality. I'm giving you 2 minutes. Tell me whether these things are the same. Sorry, my teaching style is a bit different. I'm so sure there must be somebody who really wants me to write notes. No. I know at this level, ladies and gentlemen, it's all about you getting the bigger picture for you to argue out your case. Otherwise, this thing can really be what here? Performance materiality is aggregate. There's a student asking a question. I mean, see 10%, we took 10% over the profit after tax. 10% of the profit after tax. Unfortunately, I've rubbed my figures. I miss it took long to ask the question. When you watch the video, I'm so sure you'll be okay. So I'm waiting for somebody to be able to unravel this thing called performance materiality for us. What is performance materiality? What is performance materiality? What is performance materiality? Please help me out. What is performance materiality? Anybody, performance materiality? Anybody, performance materiality? Sitawaambia. A smaller percentage of overall materiality, you are getting almost there. Almost there. Ability to affect amount of variation. Performance materiality is an amount less than the level of overall materiality and is reduced. Let me read this. And is reduced. The key thing is that performance materiality must be lower than the overall materiality. So reduced in order to allow for the risk that there may be several smaller errors or omissions that have not been identified by the auditor. Great. So performance materiality is an amount which is less than the level of overall materiality, which has to be reduced. Performance materiality applies to the whole financial statements. Actually, this is for the individual, individual items. So what will happen if, for example, I say that my overall, like I've seen this happening in practice, if my overall materiality is 100,000 for the financial statements. So what will happen, I know that there are things that are highly risky. When I look at them, not from the aggregation aspect, when I look at them from the individual aspect, I know there are things like receivables. These are things, ladies and gentlemen, that these people out there would use always to have the financial statements here being misstated. So I'll say for receivables, I would want to audit more. So during the actual performance of the audit, ladies and gentlemen, there are those particular variables whose materiality level I have to scale down. I have to scale down for them for purposes of even looking at the individual items within. Like, you know, for receivables, I'll have one debtor having 100 million, another debtor having 40 million. So it means that for receivables, I should come, in this case here, take this and say that I'm going to reduce this overall materiality by, say, 60%. So I'll say for receivables, because it's a sensitive thing, ladies and gentlemen, I would want to reduce its materiality level even further and work with, for example, 60,000 like that. So we are saying that during these actual auditing operations, there are those individual variables within the financial statements that are deemed to be high risk compared to others. So for those ones, ladies and gentlemen, given the risk of materiality, material misstatement, risk of material misstatement, and the materiality are universally rated. When I realize that there is a component like cash at hand, which in this case has a higher risk than any other component, then I'm allowed even to take my materiality level much lower, so that I can audit more. I can bring in more audit procedures into this particular single item, So you'll be able to see in the notes that I'll be able to send to you for those who are saying they don't have the book. You'll be able to see that particular area where they're talking about performance materiality. The other thing you're supposed to know, ladies and gentlemen, is that this materiality is never cast on stone. It's never cast on stone. No. Materiality, we do it, first of all, at planning stage. When we are beginning the audit, we'll be able to set our materiality level. But as we begin auditing, there are very many things that will be coming out, which will be unraveling. So as I have this new information, then I'll always be measuring my risk every time of this company. Should I get the risk of material misstatement, for example, going down? Perhaps when I came in, week number 1, had not known these guys very well. I ended up assuming that they are high risk. But as I start auditing them, I realize, hey, these guys are very organized. So once I realize that they're very organized and they have proper internal control systems, that they are low risk, then I should be able to take the materiality level up. So we are saying, ladies and gentlemen, that materiality levels are never cast on stone. They keep on doing what here? They keep on changing. Depending on the situation. They keep on changing. So what have we learned, ladies and gentlemen, so far? So far, ladies and gentlemen, what we have learned is this. In terms of risk, I've been able to teach you this very good concept of what here? Audit risk that I told you. Audit risk that I told you has got 3 components. We have the inherent risk, we have the controlled risk, and then we have the last one, which is the audit what here? The last one, it's almost going away, but cannot go away from me. It is detection what here? Risk like that. We call these 2 what here, ladies and gentlemen, we call these 2 ROM. I've been able to take you through what we call materiality, right? Performance materiality, right? I've been able to show you how to set these materiality levels using the concept of what here? RAP. So now the only thing that I'm left to do with you are what here are exercises now from our past papers, of which I would want us to start with, all right? I would want us to start with, let me tell you the one that I would want us to start with. Yes, the 2016 question number 2. 2016 question number 2. Please tell me yes when you get that question. 2016 question number 2. Do you have the question? November 2016 question number 2. November 2016 question number 2. Do you have it? November 2016 question number 2. Yes, thank you very much. So be able to read it very fast. We are told your audit firm, Macau Kilunda and Associates, are the auditors of Kikomi Manufacturing Group Limited. The group comprises various subsidiaries which were acquired over the last 2 years. The subsidiary companies operate diverse businesses, including but not limited to mining, agriculture, beauty products, and steel manufacturing works. The CEO of KMG Limited, Mr. Tim Kilonzo, is very entrepreneurial and autocratic. KMG Limited is highly geared
and recently acquired a listed company dealing in information communications technology solutions. A financial analyst had indicated in one of the respected financial magazines that the listed company was acquired at a very high price compared to the value of its assets. Another large subsidiary which manufactures skin products has been sued by customers over some products which have allegedly adversely affected their skins. Some farmers also allege that maize seeds supplied by one of the subsidiary companies were faulty, and thus the seedlings withered 1 month after germination. Required, assess the audit risk by Macau, Kilunda, and Associates in the course of the audit of Kikomi Manufacturing Group Limited. Assess the audit risk. So which audit risk are we talking about? So when they say audit risk, you'll get so many students telling us that the audit risk is that risk that the auditor may end up giving what here a wrong opinion, which is a good way to start your question. Very good way to start your question. But audit risk is that risk that I will end up making a wrong what here audit opinion, giving a wrong audit opinion. What very many students now will forget is to discuss the components of audit risk. So for example, we have here the inherent what here? The inherent risk. Inherent risk, right? Ladies and gentlemen, we have in this case here what we call the control risk. The control risk. We have in this case here what we call the detection risk. Detection risk. So now from this company, I would want a good student who will be able to identify these risks very fast, because they have told us this is a case study question to contextualize. It's a case study question. So who is able to see? You see, if I'm the one doing this, I'll define inherent risk, and then I'll come and now focus in the company that the examiner has given me. So like, is there anybody who is able to see? Who is able to see the inherent risk? But there is quite a huge possibility that even if these guys were to put all internal control systems, they'll not be able to see all the errors. Why is that the case? Is there anybody who is able to see those inherent risks? Somebody. The fact that they are running very many companies, these are risks in this case here that we cannot do what here, we can't avoid. The moment, ladies and gentlemen, you are a massive, a conglomerate, a very big organization, trust you me, it doesn't matter how many controls you put, there are things that I have to pass through. Yeah, diverse businesses. So I like in this case here where the students are talking about that the business is what is so big, massive, diverse business, diverse business, diverse business. Please talk to me. There are many there that I can see. Please talk to me. Please talk to me. Mwingine pia anaweza kaenda hata kwa example itaki kukwame mahali pamoja. Mwingine anaweza kuwa anatafuta control risk, detection risk, anaweka moja moja. Anaweka moja moja. Anaweka moja moja. You know, last semester after exam, so many students called me, mwalimu, mbona nilianguka hii paper. These are some of the reasons. So many of us in this case here think that when we get a question on audit risk, our work is simply to define what audit risk is. And then you come telling me, mwalimu, kuja kunywa chai. Where? These are tricky paper. These are tricky paper. You must always try as much as possible to do what here to really. Control risk is that the question is not functional because some products have what here. Now, there is a student who has been able to see something very important here, that if these guys had proper control systems, there is no way the company could have produced things in this case here that people are now having issues with their skin. No way. No way. Inherent risk, ladies and gentlemen,
it doesn't matter how you guys will try putting controls. We can see in this case here a defective management system, autocratic leader. I like this. Autocratic leader. Yeah, inherent risk, which those internal controls cannot detect. So could you kindly give me this inherent risks? What are some of those things that you're able to see really as an auditor, that regardless of what procedures are put in place, that hii lazima ipite, hii lazima staona. Ladies and gentlemen, if you don't mind, we should be able to start right from here in our next class. It has been a pleasure hosting you today. Thank you very much. Mary, thank you very much. You can see this concept of Mary, which Mary is giving us here, that these guys were able to acquire a subsidiary at a very high price. It means that they don't have enough controls at a high price. Patricia has also been able to confirm the same, right? How I wish we had time. I have advanced FM right now. Cheers, bye.